What most people don't understand is that we're not just watching silver climb. We're witnessing the early stages of something that hasn't happened in over 40 years. A structural break in the precious metals market that's forcing even the most skeptical institutional players to completely rethink their positions. And if you're sitting there thinking you have time to figure this out later, I need you to understand something critical. The window for acquiring physical silver at anything resembling reasonable levels is closing faster than most people realize. Let me show you what's actually happening right now, because the mainstream financial media isn't telling you the full story. They're giving you surface-level price movements and generic commentary about inflation hedges. But what's unfolding in the silver market specifically is far more significant than just another commodity rally. We're looking at the sixth consecutive year of structural supply deficits. Think about that for a moment. 6 years in a row where global demand has exceeded available supply. That's not a temporary imbalance. That's a fundamental shift in market dynamics that creates the conditions for explosive price movements. The industrial demand side alone tells a compelling story. We're seeing unprecedented consumption from the solar panel industry, electric vehicle manufacturers, and the broader green energy transition. These aren't speculative buyers who can easily switch to alternatives. These are manufacturers who need silver's unique properties. Its electrical conductivity, thermal conductivity, and reflectivity can't be replicated by cheaper substitutes. When you're building solar panels that need to last 25 years, you can't compromise on materials. When you're manufacturing electric vehicles with complex electronic systems, silver isn't optional. It's essential. But here's where it gets really interesting. While industrial demand continues to surge, mine production isn't keeping pace. We're not discovering new major silver deposits at the rate we did decades ago. The easy-to-access high-grade deposits have largely been exhausted. What remains requires more capital investment, longer development timelines, and operates in increasingly challenging jurisdictions. The lead time from discovery to production for a new silver mine can easily exceed 10 years. That means even if companies started aggressive exploration programs today, we wouldn't see meaningful new supply until well into the next decade. Now, layer on top of that the investment demand that's been building. When silver was trading in the teens and low 20s, a lot of investors viewed it as too cheap to ignore. They accumulated quietly. Now that we're seeing sustained strength and breaking through key resistance levels, a different type of buyer is entering the market. These are momentum players, trend followers, and institutional allocators who are just beginning to recognize that precious metals deserve a larger position in diversified portfolios. Before we go further, I want to make sure you have access to something valuable. I've put together a comprehensive guide that breaks down the wealth protection strategies that thousands of American retirees are using right now. It's completely free, and you'll find the link in the description below. This isn't generic advice. It's specific, actionable information about how to position yourself during periods of monetary uncertainty. Grab that guide when you have a moment, because what we're about to discuss builds on those foundational concepts. The gold-to-silver ratio is telling us something crucial right now. Historically, this ratio has averaged somewhere between 50 and 60 to 1. That means it takes 50 to 60 ounces of silver to buy 1 ounce of gold. We've seen this ratio spike during periods of extreme stress, sometimes reaching 80 or even higher. But when it compresses back toward historical norms, silver tends to outperform gold significantly. Right now, we're watching that compression happen in real time. As gold continues its own impressive rally, silver is starting to play catch-up. And when silver catches up to gold, it doesn't do so gradually. It tends to move in sharp, powerful bursts that catch most investors off guard. Let me take you back to a period that offers some important parallels. In the late 1970s, we saw a similar setup: persistent inflation, loss of confidence in fiat currencies, geopolitical tensions, and a growing recognition that hard assets offered protection that paper assets couldn't provide. Silver went from around $5 an ounce to $50 in a remarkably short period. Now, I'm not predicting we'll see that exact percentage move again. Markets don't repeat precisely, but they do rhyme. And the fundamental drivers we're seeing today, the supply constraints, the industrial demand, the monetary uncertainty, those factors are arguably more pronounced now than they were back then. What's different this time is the scale of global liquidity. and the interconnectedness of financial markets. When central banks around the world have expanded their balance sheets to unprecedented levels, when government debt has reached levels that would have been unthinkable a generation ago, when the purchasing power of major currencies continues to erode, people start looking for alternatives. They start asking themselves what holds value when confidence in the monetary system wavers. And throughout human history, the answer has consistently been precious metals. The physical market dynamics are particularly fascinating right now. Talk to any major bullion dealer and they'll tell you the same thing. Premiums on physical silver products have remained elevated even as prices have climbed. Normally, when prices rise, you'd expect premiums to compress as dealers have more inventory and buyers become more price sensitive. But that's not what's happening. Premiums are staying stubbornly high because demand for physical metal continues to exceed readily available supply. Mints are running at capacity, refiners are working overtime, and still there are delays in fulfilling large orders. This disconnect between paper silver markets and physical silver markets is widening. On the COMEX, you can trade massive quantities of silver contracts, but try to take delivery of significant physical metal, and you'll quickly discover the challenges. The futures market allows for price discovery and liquidity, but it also creates a situation where far more silver is traded on paper than actually exists in deliverable form. As long as most traders are content to settle in cash rather than demanding physical delivery, the system functions. But what happens when a growing number of participants decide they want the actual metal? We're starting to see signs of stress in that system. Warehouse inventories at major exchanges have been declining, not crashing but steadily drawing down. Meanwhile, central banks, which historically focused primarily on gold, are showing increased interest in silver as well. Sovereign wealth funds are diversifying into physical precious metals. Large institutional investors are allocating capital to metals-backed ETFs and direct ownership of bullion. This isn't retail speculation. This is smart money positioning for a monetary environment that looks increasingly unstable. The geopolitical dimension adds another layer of urgency. We're watching the emergence of alternative payment systems, challenges to dollar dominance, and a multipolar world order that's fundamentally different from the post-World War II framework we've operated under for decades. When major economies start settling trade in currencies other than dollars, when gold-backed payment systems are being discussed seriously, when the BRICS nations are exploring alternatives to Western financial infrastructure, these aren't just headlines. These are structural shifts that have profound implications for how we think about storing wealth. Think about what 1 kilogram of silver represents. That's roughly 32 troy ounces. At current levels, that's a meaningful but still accessible investment for most people who are serious about protecting their wealth. It's not some enormous position that requires institutional capital. It's an amount that individuals and families can acquire. But here's the critical point. 1 kilogram of silver gives you tangible, physical exposure to a market that's experiencing fundamental supply-demand imbalances. It's not a stock that can be diluted. It's not a bond that can be defaulted on. It's not a currency that can be printed into oblivion. It's a finite physical asset with industrial utility and monetary properties that have been recognized for thousands of years. Now, let's talk about the practical implications for retirement accounts, because this is where a lot of people get stuck. They understand the case for precious metals, but they're not sure how to actually implement it within their existing financial structure. If you're sitting on retirement savings in traditional accounts, you have options that most people aren't aware of. Quick aside here, if you have $100,000 or more in retirement accounts, I've put together a detailed guide on how gold IRAs work. It's in the description. This covers the mechanics of getting physical precious metals into your retirement account without triggering tax penalties or early withdrawal issues. It's worth reviewing if you're thinking about how to position your retirement savings for the kind of monetary instability and market volatility we're likely to see in the coming years. All right, back to the bigger picture. The solar industry alone is projected to consume massive quantities of silver over the next decade. Every solar panel requires silver paste for the photovoltaic cells. As countries around the world commit to renewable energy targets and phase out fossil fuels, that demand isn't optional. It's baked into infrastructure plans and climate commitments. The electric vehicle revolution is similar. Each EV contains significantly more silver than a traditional internal combustion vehicle. As EV adoption accelerates and all the major automakers have committed to electrification timelines, that creates a demand floor that didn't exist a decade ago. But it's not just about new technologies. Silver has applications in medical devices, water purification, electronics, photography, and countless industrial processes. It's one of those materials that modern civilization depends on in ways most people never think about. You're surrounded by products that contain silver. The phone in your pocket, the computer you're watching this on, the appliances in your home. Silver is embedded throughout our technological infrastructure. And as that infrastructure expands globally, particularly in developing economies that are industrializing rapidly, the demand trajectory points in only one direction. The supply-side constraints are equally important to understand. Silver mining is often a byproduct of other mining operations. Most silver comes from lead-zinc mines, copper mines, and gold mines, where silver is a secondary product. That means silver production is tied to the economics of those primary metals. If copper prices fall and copper mines reduce production, silver supply falls as well, even if silver prices are rising. This creates a situation where the silver market can't simply respond to price signals by ramping up dedicated silver mining. The supply response is muted and delayed. We're also seeing increasing resource nationalism in key mining jurisdictions. Countries that host major mineral deposits are demanding larger shares of the economic benefits. They're imposing higher royalties, stricter environmental regulations, and in some cases, outright nationalization of mining assets. This creates political risk for mining companies and reduces the incentive to develop new projects in certain regions. The result is that even when silver prices rise, the supply response is constrained by factors beyond simple economics. Let's talk about what happens when physical shortages become more apparent. We've seen this dynamic play out in other commodity markets. When buyers realize that supply is genuinely constrained and that waiting means potentially not being able to acquire the product at all, behavior changes. People who were casually interested become urgently motivated. People who were planning to buy eventually decide to buy now. This shift from casual interest to urgent demand can happen quickly, and when it does, prices don't move in orderly fashion. They gap higher as sellers realize they have pricing power and buyers realize they need to act. The 1 kilogram threshold is significant because it represents a commitment. It's not buying a few coins as a curiosity. It's not dabbling with a small position. 1 kilogram says you understand what's happening and you're taking meaningful action. It's enough to matter in your overall wealth protection strategy, but it's still accessible before prices move significantly higher. Think of it as establishing a position before the crowd arrives. Because once the mainstream financial media starts running stories about silver shortages, once your neighbors and coworkers are talking about buying silver, the opportunity to acquire it at current levels will be gone. History shows us that precious metals bull markets tend to move in stages. The first stage is quiet accumulation by informed investors who understand the fundamentals. The second stage is when momentum builds and technical traders start paying attention. The third stage is when the general public becomes aware and FOMO drives prices to levels that seem irrational in hindsight. We're somewhere between stage 1 and stage 2 right now. The fundamentals are clear to anyone paying attention. The technical picture is improving. But we haven't yet seen the kind of mainstream awareness that characterizes the final stage of a bull market. The monetary backdrop is crucial to understand. We're operating in an environment where real interest rates, that's nominal rates minus inflation, remain deeply negative in many cases. When you can't earn a positive real return on cash or bonds, the opportunity cost of holding precious metals disappears. In fact, metals become attractive because they preserve purchasing power without counterparty risk. You're not depending on a government's promise to pay. You're not relying on a corporation's creditworthiness. You're holding a physical asset that has intrinsic value. The debt dynamics in major economies are unsustainable by any historical measure. Government debt to GDP ratios have reached levels that historically have led to either default, restructuring, or inflation. Since outright default is politically unacceptable for major economies and restructuring is complex and painful, the path of least resistance is inflation. Allowing the currency to depreciate gradually reduces the real burden of debt. It's a stealth default that happens slowly enough that most people don't recognize it until it's too late. Precious metals are the traditional hedge against this dynamic. We're also seeing a generational shift in how people think about money and value. Younger investors who have grown up in an era of quantitative easing, negative interest rates, and unprecedented monetary experimentation are questioning the assumptions that previous generations took for granted. They're more open to alternative stores of value, whether that's cryptocurrencies, precious metals, or other hard assets. This demographic shift is creating new demand from a cohort that will be accumulating wealth and making investment decisions for decades to come. The industrial applications continue to expand in ways that weren't anticipated even a few years ago. Silver's antimicrobial properties are being utilized in medical settings, particularly in the wake of increased focus on infection control. Its use in 5G infrastructure is growing as telecommunications networks are upgraded globally. Advanced battery technologies are exploring silver-based components. Each of these applications represents incremental demand that adds to the baseline consumption from traditional uses. When you look at the totality of the situation, the supply constraints, the industrial demand growth, the monetary uncertainty, the geopolitical shifts, the technical picture, it all points toward a market that's fundamentally mispriced relative to where it's likely to be in the coming years. The question isn't whether silver will be higher. The question is whether you'll have positioned yourself before the move becomes obvious to everyone else. 1 kilogram of silver is a stake in the ground. It's a declaration that you understand what's happening, and you're taking action while others are still debating. It's not about timing the perfect entry point or trying to catch the absolute bottom. It's about recognizing that the risk-reward profile is heavily skewed in favor of ownership at these levels. The downside is limited by production costs and industrial demand. The upside is substantial given the supply-demand imbalance and the monetary environment. Think about what happens if we see even a modest acceleration in investment demand. If just a small percentage of global investment capital decides to allocate to physical silver, the available supply would be absorbed quickly. The silver market is relatively small compared to other asset classes. It doesn't take massive capital flows to move the price significantly. That's both an opportunity and a risk. The opportunity is that early movers can establish positions before prices adjust. The risk is that waiting too long means potentially being priced out of the market entirely. The premiums on physical products are telling you something important. They're telling you that the people who are actually in the business of buying, storing, and selling physical metal see strong demand and limited supply. They're not lowering premiums to attract buyers. They're maintaining or raising premiums because they can, because buyers are willing to pay up to secure physical metal. That's a market signal that shouldn't be ignored. We're also seeing interesting developments in the mining sector. Companies that produce silver are being revalued by the market. Their stock prices are starting to reflect the improved fundamentals for the underlying commodity. But there's a lag. The mining stocks tend to move before the physical metal in the early stages of a bull market. Then the physical metal catches up and often surpasses the percentage gains in the miners. We're in that transition phase now where both are moving, but the physical metal still offers compelling value relative to where it's likely to be. The central bank behavior is particularly noteworthy. These are institutions with access to the best research, the most sophisticated analysis, and deep understanding of monetary dynamics. When they're accumulating gold at record pace, when they're diversifying away from dollar-denominated assets, when they're building physical reserves rather than holding paper claims, they're telling you something about how they view the future. They're not doing this for short-term trading profits. They're doing it because they understand the long-term trajectory of the monetary system. The COMEX dynamics deserve attention because they reveal the tension between paper markets and physical reality. The exchange serves an important function in providing liquidity and price discovery, but it also creates a situation where leverage and speculation can temporarily suppress prices below where physical supply and demand would naturally clear. As more participants demand physical delivery rather than cash settlement, that tension becomes more apparent. We've seen brief episodes where delivery demands stress the system. Those episodes are likely to become more frequent and more severe as the supply-demand imbalance worsens. For those of you who have been watching this market for a while, you've seen false starts before. You've seen silver rally and then pull back. You've seen predictions that didn't pan out. I understand the skepticism, but what's different this time is the convergence of multiple factors that are all pointing in the same direction. It's not just one catalyst. It's a combination of structural supply deficits, unprecedented industrial demand growth, monetary instability, geopolitical realignment, and technical breakouts. When you see that kind of alignment, the probability of a sustained move increases dramatically. The 1 kilogram position is about having enough exposure to benefit meaningfully from the move that's coming, while still being a manageable allocation for most serious investors. It's not betting the farm. It's not going all in on a speculative trade. It's establishing a core position in a hard asset that has thousands of years of history as a store of value and is experiencing supply-demand fundamentals that haven't been this favorable in decades. As we wrap up here, I want to make sure you take advantage of the resources available to you. If you've watched this far, you're clearly serious about understanding what's happening and positioning yourself appropriately. The guide I mentioned earlier in the description, that's your starting point. It covers the foundational strategies for wealth protection in this environment. But for those of you with substantial retirement savings, there's something else. If you're an American retiree with at least $100,000 in any retirement account, you can schedule a free one-on-one educational web conference. No obligation, no pressure. Just a detailed walkthrough of your options and how to implement them. That's exclusively for people who mention they watch this video. It's in the description below. The window for acquiring physical silver at these levels won't stay open indefinitely. Markets have a way of staying irrational longer than you expect, and then moving faster than you anticipate once they finally break. The smart money is positioning now, while prices are still reasonable and physical metal is still available without significant delays. 1 kilogram of silver is your stake in a market that's fundamentally broken and due for a major repricing. The question is whether you'll act while you still can, or whether you'll look back months from now, wishing you had moved when the opportunity was clear.